Hello, I'm Andy Beresford of Tawny. Thank you for your time and thank you for joining us for the latest Tawny investment webinar. It has of course been a very turbulent year, so we'd like to send our best wishes to you all and we hope everybody is staying safe and well. There have been a number of challenges of late from the investment perspective, so James Hall of Cazenove will be joining us to give us a concise insight into markets, taking a look back over the last 18 months and telling us what we could expect to see moving forwards. James will also look at topical issues such as inflation and talk to us about what that could mean for us all.
Hello everyone, and thanks for the introduction, Andy. My name's James Hall. I'm a portfolio manager at Cazenove Capital, and today I'm just going to talk to you a little bit about markets, where they've been over the last 6 to 18 months, where they're headed, and the sort of trends that we're seeing in markets at the minute. So to start us off, we're going to look back at what's happened. So this chart here is just showing in the pink bars what's happened over the year to date. But just before I start on that, let's look back at 2020. And as we all know, COVID hit quite early on in the year and it saw a 35% decline in stock markets, culminating on the lows on April the 22nd. At that point, the Federal Reserve and other governments put a lot of money into markets and markets rallied from that point to roughly where they are today. Global stock markets finished the year up by around 13%. The US markets were up between 10 and 18%, depending on what index you look at, and the FTSE 100 was down 13%. Emerging markets were up around 15%. If we look towards how markets have performed this year, towards the right-hand side of this chart, you can see that emerging markets have struggled to make ground. Whereas last year they dealt with COVID very well, they shut their economies down and were able to move around. This year, the Indian variant and lack of vaccine distribution has really held those stock markets back. Back over to the UK and the US, and you can see that the UK is ahead of the US, only marginally over the year to date, but still ahead. And that's clawed back some of those huge losses that we saw, or the huge difference we saw last year. So to see why those differences occurred, as we did last time, let's have a little look under the bonnet at what actually makes up the indices. So here we can see the different sectors, and if you look in the middle there, you can see the growth sector. So the growth bucket generally includes things like consumer discretionary and information technology. So these would be companies such as Amazon, Google, Facebook. These companies did phenomenally well last year. COVID was actually a very positive for their business model and they made a lot more money, so they were up very strongly last year. This year, they've struggled a bit and they've only made a little bit of ground over the start of the year. And really, the reason for this is that we've seen a bit of a shift in stock markets since the vaccine was announced last November. Traders have decided to take profits from these areas and instead they've moved into more reopening style trades as the world starts to move again. These would be things such as oil, energy and financials, which you can see here have moved up almost 20% over the year so far. The FTSE 100 is made up almost 50% by these sectors, which is why it's outperformed, but why it lagged so much last year. FTSE has under 1% exposure to technology, whereas the S&P 500 has a real good chunk in it. So that's what's happened in markets so far. Let's have a little bit of a look at the other areas of markets. So here we're looking at crude oil, which is effectively the oil you put in your car, oil used for manufacturing. And if you've gone to the petrol station recently, you've probably seen that the oil price has gone up quite markedly. This time last year, it was almost below $30 a barrel, and it's climbed to over $70 a barrel now. Oil itself is a key component of inflation, and this is one of the reasons why inflation is starting to nudge higher. Gold is broadly flat over the year to date, having started very poorly. It was up 8% over May as some of the higher inflation numbers came through. Gold is traditionally seen as a very good hedge against inflation, which is why it's rallied over May. The other bar charts really chart mainly sterling and how the currency's performed against other currencies such as the dollar and the yen. It's 10% stronger against the yen over the year to date. And really the reason for the sterling's success is twofold. Firstly, we've seen a Brexit deal being done, and that really makes the UK more investable from a foreign perspective, whereas before there was a bit of a question mark hanging over it. But perhaps the main reason for the rally in sterling has been the way that the UK government has rolled out the vaccine very, very fast and very effectively. Finally, on markets, we're just going to have a look at the fixed income market. So this is the bond market. If you give your money to an entity for a period of time, they will pay you back with a coupon. So here we're looking at governments that back that debt. And if you give your money to the US government at the minute, you get around 1.5% a year for 10 years. And what you can see there on the left-hand side of this chart is that government bonds have fallen a lot this year. And really, as we've seen inflation come through towards 3% or more, when you've locked into 1.5% on a bond, it's really quite unattractive. And so the bond price has had to fall to adjust for that. So holding conventional bonds has been poor. On the right-hand side, you can see bonds which pay a coupon which is linked to inflation. So the coupon is uplifted by inflation. These have been a lot less impacted because of that. So that's markets in general. Let's have a look at where we think things are going forward. This chart here shows global growth. So it's really the engine room, the heartbeat of the world. What we can see here over the last 20 years, if you look in the middle, you can see the great financial crisis, and you can see how that affected us and how it affected growth. The world slowed by almost 0.5%. You fast forward to last year and COVID, and you can see how much deeper that recession was, almost 3.7%. But what we're seeing and what we're forecasting is strong growth going forward. So we're seeing a 5% bounce back this year and perhaps up to 5% again in 2022. And really the reason for this is households have got a huge amount of savings built up. And as the world reopens, we expect people to go out, spend again. This is very supportive for economies. Almost 2/3 of the GDP spend is due to households. So let's have a look at the risks here, because remember those figures we've just seen are forecasts. So what are the main risks that could knock these forecasts? So COVID certainly is one of them. The speed at which vaccines are rolled out is important, but really the efficacy of the vaccine is the most important. And we've seen some really quite nasty variants, such as the Indian variant, which so far the vaccine is proving effective again, which is great. But of course, there could be a new variant or a new strain that could prove ineffective against the vaccine. This is not our base case, but it is something to consider. In terms of the vaccine distribution, if we look on the left here, you can see, as we well know, that the United Kingdom and the United States have actually done a fantastic rollout. In the UK, we've nearly got all adults done. Europe got off to a slower start and they're much maligned for that, but they are now catching up. Indeed, Germany are giving around 1 million doses a day. Over in the Far East and Asia, it's been very much a different story there. And really, some of these economies, such as India and Brazil, really struggled to get hold of the vaccines. The more developed ones, such as Japan, Australia, New Zealand, they've gone for a bit of a different approach when it comes to COVID. They've decided to shut their borders, not allow people to come into the country, and therefore within the country they're moving around, and they're happy with this. But that's meant they're slower with getting the vaccine going, and they've actually decided to test it more and take their time. So Australia have already said their borders are going to be shut, likely to be until the late next year. Japan, interestingly, have an Olympics to host in just under 3 weeks. And this is really interesting, not only from a sporting perspective, but also from a financial perspective. They have sold $800 million worth of tickets, and it's very unlikely that they're going to allow supporters into grounds. And if they don't, the government, who have already spent that $800 million, are going to have to refund it to people. So there's something to watch out for there. Now, the other main risk out there is inflation. And if you've been looking at the news recently, you've probably seen a lot of headlines about inflation. And Andy, quite rightly, has asked me to spend a little bit of time here discussing inflation more in depth. So this is US CPI inflation, and this is just the bars that make up the different components. Before I dive into this, I probably should say, a little bit of inflation around the 2% level is actually generally very good for healthy economies. What we really don't want to see is persistent inflation north of 3%. And that is exactly what we're seeing at the moment. It's quite clear that there is inflation. And the two main reasons for this is, firstly, as the world reopens again, we saw that oil prices shot up as people move around, as manufacturing begins again. And that's that green bar you can see in this inflation spike here. The other thing that's causing a spike is, I don't know if any of you have perhaps tried to buy a car recently or anything around the house, furniture. There really is a huge bottleneck and there's a complete lack of supply, which is pushing the price of these things up. And really that's due to COVID. There was a manufacturing slowdown last year, and as the world's reopened, the flow of goods around the world has really been hampered. Firstly, a lot of mariners are Indian, so the ships have been unable to get crews. Some of the ports in China have had to shut down because of local outbreaks of COVID. And then we had just a month or two ago the Suez Canal being outright blocked by a ship, which hasn't helped at all. But once these things reopen and once the manufacturing flow happens again, we do think, importantly, this will settle down. So we think this inflation figure is going to be what they call transitory or temporarily, and it will settle down again. We do, however, have some concerns in inflation towards 2023. And this is really looking at that dark blue bar, which we call core CPI. We believe that there could actually be wage inflation out there. And the reason for this is as growth is coming through, jobs are created, the labour market goes into those jobs and unemployment falls, which is good for economy. But if it falls to a certain point, companies have to pay more to entice staff in, and this is inflationary. An example of that at the minute in America, if you on state benefit, you receive around $37,000. Now the baseline job in McDonald's, say, is around $37,000. So McDonald's and their peers are going to have to pay more to get people into these jobs, and we think that could be inflationary. So this is something for us to watch out for. It's not necessarily a bad thing, but if it gets too high, it could be. So we're looking at maybe adding more gold, inflation-linked bonds, and indeed even some equities that might benefit from this to portfolios. So just to some sort of positives to finish with almost. Here is the earnings chart, so that how much a company's earning, and you can see in 2020 there was a huge fall of earnings across the board, but this year they've bounced back incredibly strongly. Companies like Microsoft, Apple, Google have all had fantastic Q1 earnings reported, and we believe those to continue. Next year as well, we think earnings will be good. So this is supportive because you've got growth and you've got good earnings. Another reason which is incredibly supportive, and we spoke about it earlier, is the amount of money that's out there. So this red or pink line here just shows how much people's savings has grown over the last year or so. So bank balance are on average 20-25% higher. And as I said earlier, once this month people are allowed to spend again, they will go out and spend the money. If they're not spending the money, then people are now quite wary of sitting on cash, because with cash giving you nothing and inflation being 3 to 5%, you really are going backwards. And we think people's money will find its way into stock markets as well. The other reason here is the blue line, which just shows you how much money effectively the Federal Reserve and the US are printing. You can see how much their balance sheet has expanded. So this money, again, is very supportive for markets. They have just said that they're going to taper the amount they're putting in over the next few years, but it's been very well signposted and markets are comfortable with that at the moment. Should they take the money supply off the table quicker, then it could cause some jitters in the market, and of course that's something for us to look out for. So just before I close, just a quick look at a theme we've been adding to portfolios this year and over the past 12 months. And really this is the green agenda. And if you look at the G7 summit that we had in Cornwall a week or two ago, we saw the leaders get together there. And one of the things they talked about was a green agenda and committing more money towards that. The German government just last week said that they were going to add 6 billion a year to green initiatives. And this is obviously great for the environment, but it's also good from an investment perspective as well. And we've put into the portfolios a fund that can benefit from coming away from fossil fuels and buying things like electric vehicles and wind farms, etc. So this is a long-term theme for us. So really to conclude, what are our thoughts on markets? Well, yep, valuations are a little bit higher than perhaps we've seen in the past. But when you look at how strong the growth figures are and the earnings are there to support it, as well as that wall of liquidity, we are positive on markets over the next 12 or so months. As always, there are risks out there, higher inflation and the COVID variant, as well as some other things. But as I said earlier, we generally are positive. So that's it from me. I'd like to hand back to Andy, who's going to say a few words.
Thank you, James. Clearly some great and thought-provoking points raised. Many of you will have taken the time to reflect on things over the last 18 months. And at Aaron Tawny, we continue to be on hand to help, guide and support you as we hopefully move towards the end of the pandemic and onto a bright and prosperous future. We hope you found the update of interest. And if you have any questions, thoughts, observations, please feel free to get in touch. As ever, we value all of your feedback. Please stay safe, and we look forward to continuing to work with you all in the future. Thank you for your time.